Okay, hi everyone. This is going to be the second lecture on chapter 2. So let me move this out of the way. So here, right, we're going to be picking things up. We talked about so far the due dates for taxpayers, who must file, when must they file. We talked about the statute of limitations, right? We said what is the window within which, after they file, the IRS can come after them. We talked about the IRS, how they audit tax returns, what mechanisms they use, and then the types of audits. We looked at the court system a little bit, and now we're going to be looking into tax law sources. Okay, so that's where we're picking things up. So let's first distinguish here primary authorities from secondary authorities. So primary authorities are official sources of law. They come directly from the government. So they could be legislative, right, like a statute, a code, right, the tax code. They could be judicial, right, like a court decision, right, they write an opinion. Or they could be like executive or administrative, so like a regulation from the IRS, right? The overall idea here is it's coming from the horse's mouth. That is, the government itself is creating the law. It's a primary authority. In distinction, right, there are secondary authorities. These are not directly from the government. And what secondary authority does is it helps to interpret primary authority. So it's unofficial sources of law, right? So for example, our textbook in this course, right? The government didn't directly make that. Accordingly, it's not going to be primary authority, but it could be secondary authority, right? It helps to interpret primary authority. So when we're looking at primary authority, right, we have legislative sources, we have judicial sources, and then we have administrative. So legislative sources, right, we have the Constitution, right, that's directly coming from the government. The 16th Amendment, right, we can look at that there, but essentially that allows the federal income tax. Then we have the IRS code, right? So the idea with this is, if you remember your civics class in high school, right, you got that bill on Capitol Hill. The idea with this is when the federal government passes laws, right, statutes, that gets put into the United States Code, right? It's like a general, like giant book that has all of the federal laws. Part of that United States Code is known as the IRS Code, right? And you can see how it's broken out. It gets very detailed very quick. And the idea it can be cited there. That's another type of primary authority. Also, we have tax treaties, right? So the idea here is these are entered into by the president. They control tax situations between countries. So by way of example, right, if I went to France and I was working there and I was a U.S. citizen, a tax treaty could be used to help explain the tax consequences of citizens working in, living in different countries and having income. All right, let's talk a bit about tax law here, right? Say that we have a tax law we want to create. How specifically does this manifest and work its way through the legislative system to become a law? Well, the starting point is the House of Representatives Ways and Means Committee. So the idea with this is if you were a House member, right? Let's just say there was 100 of them, right? And there's a different amount, but let's just keep it simple. Of that amount, they kind of put them into groups, right? You're in group A, you're in group B, you're in group C. And the idea with this is instead of calling them groups, they're committees, right? So one committee might be the crime committee. One committee might be, the environmental committee. It's, the idea here with it. Well, one of those is going to be the tax committee. And specifically, that's the House of Representatives Ways and Means Committee. And essentially what they're going to do is draft the tax bill. Right? If it's passed, it becomes an act. And what happens then is they punt it over to the Senate. And in the Senate, right, they also are put in groups and committees. And the committee there that deals with taxes is called the Senate Finance Committee. So essentially it starts in the House, we create an act, we punt it to the Senate's Finance Committee. We have version 1, we send it over to the Senate Finance Committee. They look at it, right? They debate about it. Hey, we like A, B, and C, but we want to change D, E, and F to it, right? They review and modify that act. They then pass it as a separate act, version 2, right? So we had version 1 from the House, gets sent over to the Senate. They modify it. It's version 2. Version 2 then gets sent to this joint conference committee, right? That's kind of where both houses come together. They send people there into a committee. They work out the differences, right? The House said this, the Senate said that, version 1 and 2. Now what we're going to do is iron these out, iron out the differences, and come together and pass version 3, right? Once we get version 3, both sides agree to it. It gets sent to the House to vote on. It gets sent to the Senate to vote on. Hey, there we go. And once it's voted there, it's going to be sent to the president, right? The president can either sign it into law, where it becomes part of the Internal Revenue Code, or alternatively can veto it, say, no, I'm not going to do that. But if the president vetoes it, tries to kill it, it can then be overridden by a two-thirds vote in both chambers. So you can look at it there. The courts, right? Let's talk about them, right? We're talking about primary authority. We say, hey, the courts, they can issue opinions that would be primary authority. Now, in theory, right, the courts are supposed to interpret the law and apply it. They're not supposed to be creating law, right? In other words, we're creating law in our court opinions. We're just supposed to be interpreting it. That's not always the case for how it works in real life. But generally, when you're describing courts, you kind of have a trial court and an appellate court. So in other words, like an initial court, and then if you lose, you go to the appellate court. And sometimes there can be appellate courts to the appellate courts. So here in our system in the United States, the first court, that is to say the trial court, the first one you go to for tax purposes, would be the district court, the tax court, or the court of federal claims. See lecture 1, the idea with this is, do you want to pay up front, try to fight for the refund? What type of judge do you want? Do you want a jury? So on and so forth. That first kind of bite at the apple for where you pick you go, that's known as the trial court. If you were to lose there in the trial court, right, you would go to the first level of the appellate court, namely the circuit courts. If you lose again at the circuit court, right, and you want to appeal it, then you would go to the Supreme Court. But the Supreme Court just doesn't let everybody in, right? They have to grant this writ of certiorari, which essentially says, hey, we are going to hear the case. And in reality, there's not many tax cases that make it to this level. Now, in this framework, right, in the US, we have this kind of idea of Starry decisis, which means let the decision stand. That's a fancy way of saying that courts follow precedent. So in other words, courts, when they make decisions, right, that's setting a precedent for a future rule in law to be applied. So in other words, we have a statute, there's a fact set that happens in real life. The court says, in light of this fact set, we're going to apply the law. Here's the outcome. Moving forward, right, in the future, other courts can use that precedent to apply it to different fact sets. And in this way, we also have kind of a layering here of the importance of courts in the hierarchy of precedent. In other words, the Supreme Court decisions are going to be the highest version of precedent. The circuit courts are going to have to follow that as well as the trial courts. Below that, you have the circuit court precedent. So the idea with that is the trial courts follow the precedent from the circuit courts. And internal to the trial courts, they have their own precedent. Overall, you can kind of think of it like, you have a boss over you, right? The trial courts, the precedent they're looking at in their decisions are the circuit courts and the Supreme Courts. The circuit courts, the boss over them, the precedent they're looking at is the Supreme Court. So in the district courts, for example, if we go back here just to show you, right? First off, when we're looking at this map, what's it showing here? It's showing the geographic boundaries for the circuit courts. So there's 13 of them, right? So like 1, 2, 3, 4, count it, that's great. Here's the idea, right? Let's say that we go to West Virginia, right here, we file in the district court. first bite at the apple, that's our trial court. We're going to the district court. If you're the judge, right, sitting on that, and you're saying, I'm a generalist, I need to follow the precedent here, what you would look to, right, you kind of would look to this blue area here. In other words, I would look at, if I was the judge there, and follow the precedent from the Fourth Circuit, right, the appellate court from the Fourth Circuit, not any of these other kind of circuits over here. Similarly, right, if we were in California and we were the trial court judge in the district court, we would follow the precedent from the Ninth Circuit. So you're not just like picking over here whatever you want. You're kind of limited by which circuit you fall under. So there's 13 different ones here. But this begs the question, right? It's easy if I'm the district court here or here, I just look to where I'm at. What happens if I'm the tax court, right? Because the tax court kind of represents this whole shooting match here. When I'm trying to apply precedent from the tax court, do I use the Ninth Circuit, the Eighth, the 10th? Do I get to pick and choose? Well, the idea with this is, if we go back here, let me see if I can find it. Sorry, I'm jumping all over here, is we have this Golson rule. And it basically says this: the tax court, they're going to follow the rulings of the circuit court, the appellate court, that has appellate jurisdiction for the case. So in other words, if we're the tax court, right, we're hearing a case in Pennsylvania, we're going to follow the Third Circuit Court of Appeals. If we're in West Virginia, right, we go back, here we are, it gave rise to here, they have appellate jurisdiction. We're going to follow the Fourth Circuit. So it's almost like the tax court steps in the shoes of the district court judge. Wherever this gave rise, the facts and circumstances of the case, we're going to look to the circuit court for that jurisdiction to tell us precedent if we're the tax court. So I know that's a mouthful, but just imagine you were the tax court judge, right? It would be a headache to look at all of the precedent from there. No, we have this Golson rule that helps clarify the precedent we're going to use. All right, the next thing here, administrative sources. So one thing with the law is there's statutes, but there's way more regulations, right? We live in a very regulatory society. And with tax laws specifically, those are going to be created and administered by the Treasury Department, the TD, right? They'll issue regulations. And essentially with regulations, there's three types and there's three purposes. So the types of regulations, right? We essentially have proposed regulations where, hey, we want to do X. We're proposing this. We now leave open a 6-month window for notice and comment, right? It's basically what we're planning on doing. We're proposing to doing this. Now, afterwards, after we propose them and we get a notice and comment period, essentially the regulation then can go into effect. And in that way, it can be effect temporarily or more permanently. So afterwards, you can have a temporary regulation, right? It can be good for a finite period of time, generally up to 3 years, or a final regulation. It's just good indefinitely. So that's the idea here with regulations. If you see a proposed one, that's not yet law. It's just a proposal of what we want to do in the future. Afterwards, in the future, when it goes into effect, it can be temporary or final. Likewise, right? Once we have the regulation, what is the purpose of it, right? Well, there's generally three types of regulations. You can have an interpretive, a procedural, or a legislative regulation. The most common is going to be an interpretive regulation. And what happens here is you kind of have an underlying or like anchor statute. So what they're doing here with the regulation is really interpreting that statute. By way of example, right? Gross income, section 61 of the code, a statute. It says gross income, is going to include A, B, and C. Afterwards, right, we have this anchor statute. We'll get the regulation that helps explain what A is. It helps explain what B is, right? It's really kind of filling in and giving specific details of a statute. So that would be an interpretive regulation, and that's the most common. Similarly, we have procedural and legislative regulations. Procedural regulations are exactly that. They relate to procedural matters. So things like the statute of limitations, how you might file, right? They're not really substantive law, they're procedural. Finally, we have legislative regulations. These are the rarest type. Essentially what happens here is Congress is giving kind of full authority to the Congress is giving full authority to the agency to cover a particular topic. Hey, we want topic X. We're going to task you, the IRS, with creating all of the regulations on this. So we talked about regulations. They come from the Treasury Department. We also have revenue rulings and revenue procedures. So the idea with these, right, what's going on here? A revenue ruling is almost like a hypothetical court case. And what I mean by that is what you'll normally see in there is like some type of like fact set, right? Here's Joe Smith. He wants to do A, B, and C. He's trying to take this deduction. And then you'll have a long explanatory analysis of how, the IRS would interpret and rule on this matter. So it's kind of like facts and application. It's kind of telling a story of what the IRS thinks. So that's the idea of a revenue ruling. A revenue procedure is more quantitative. And what I mean by that is, hey, maybe we have a revenue ruling that tells the story of Joe Smith and says he's allowed to take a mileage deduction. Thereafter, a revenue procedure would really get into the nuts and bolts, the quantitative part of that. How are we going to calculate this mile deduction? So maybe they would then thereafter issue a revenue procedure giving charts and tables and figuring out how to calculate what it is they said in the revenue ruling the taxpayer is allowed to do. Further, we have private letter rulings. So these are specific to an individual taxpayer. What happens here is essentially they're writing into the IRS, I want to take this deduction in the future. Am I allowed? The IRS responds in a letter, a private letter ruling. But the idea here is this is only binding to the taxpayer. So in other words, the IRS will respond and say, yes, you can do this, but you can't take an external party's private letter ruling into a court of law and say this must apply to me. In other words, you can't go into a court and say, hey, Joe Smith over there, he had this private letter ruling that says he's allowed to take the deduction, therefore I'm allowed to take the deduction. No, it's not binding, right, on you. It's only binding on Joe Smith. So that's the idea with it. Now, that's not to say you can't take it into a court of law and say, well, I know this isn't binding. I want to show that it's persuasive. In other words, you should rule in my favor here because I do have a similar fact set. I can't require you to, but I would argue that I'm close to him. So consider that. A TM is something similar, right? You can look at that there. That comes from the Office of the Chief Counsel. It usually looks at a transaction after it happened instead of before it happened, like in a PLR. And then notices and announcements are more like public comments from the IRS. A very typical one is, hey, we have an announcement or a notice. We are accepting e-filing for the 2024 tax season on January 15th, right? They're just kind of like general publications or notices. So in this hierarchy for administrative sources, again, this is primary authority because they're coming directly from a government agency. The regulations are going to be greater than the revenue rulings, are going to be greater than the revenue procedures, are going to be greater than the PLRs and the TAMs. Okay, so say that you fought this battle with the IRS, you went through the courts, you won, you get the smiley face, the IRS gets the sad face. How does the IRS then kind of respond to this? Well, essentially, anytime the IRS loses a case, it's almost like they give a little report, right? And this report is called the action on decision, which essentially says how the IRS feels about things. And what I mean by that is in the action on decision, they're going to say, hey, we agree with the outcome of this case. We lost, right? We know we lost. We're just going to give up on it. What we mean by that is taxpayers in similar situations in the future, we are not going to litigate this. On the other hand, right, they can have an action on decision that says this is going to be a non-acquiescence. And what that means is kind of like we lost the battle, but we didn't lose the war. In other words, the IRS is taking the position that while we lost this case, we believe we lost it specific to the facts and circumstances of this taxpayer. In other words, if you later on try to take the same position, be aware that we're going to litigate it, right? We're like not acquiescing or bowing down here. All right, so tax research, you can look at this. Essentially, they're going to give you a 5-step process here. Generally, you only do tax research later on in your career, but you're going to want to look at the facts, identify the legal issues. Once you kind of get that picture in your head of the legal issues, you're going to go research it. A lot of this naturally happens in your head in the sense like your client comes in the door, they're telling you a story, and you're naturally filtering this, kind of applying the tax provisions in your head. Afterwards, right, you're going to analyze the tax authorities and then document and communicate your results. So usually in practice, it might be like, they're more formal here with like a memo. It could be just something like calling the client and saying, hey, we found out you're allowed to take this deduction. It could be an email, right? Hey, we just wanted to let you know you qualify for this credit. Okay, last kind of area here, we're going to talk a little bit about ethics. So first thing here is we have the AICPA, namely the American Institute of Certified Public Accountants. They have kind of two provisions that apply to taxpayers. The first here are the statements of standards on tax services, right? So those are directly like kind of rules for tax preparers. You're going to be a tax accountant, you're subject to these. Second, we have their code of professional conduct. So this applies, it's like a broader standard. Anybody who's a member of the AICPA is subject to this. So if you're an auditor, right, you may not be subject to the statements of standards for tax services, but you would be subject to the code of professional conduct, assuming you were a member of the AICPA. And a lot of firms will make you become a member. Finally, right, the IRS, they want their bite at the apple on this, right? They produce the Circular 230, which sets kind of standards for tax practitioners. Continuing, right, we have the state boards of accountancy. So they're the ones who issue the CPA license, right? You have AICPA and NASBA. They create the exam, they administer it. Once you pass, right, if you want to do the CPA exam, you take your results and you apply to the state board. So, if you get in trouble or something, if you have a CPA license, the state board is going to have rules and stuff that say we're revoking it. You can't do this. You can't do that. That's the idea with the state board. And then obviously, right, you have common law. So things like negligence standards, contract law. As an accountant, right, if you fail to act reasonably and you cause your client damage, you could be sued for negligence. So these are all kind of like standards of what's going on for how you should act as a tax accountant. Now, with this, right, and a few other things we should be aware of here are penalties, right? And these can apply to the taxpayer or the tax practitioner, right? They can get the taxpayer, like individually, for they didn't do this or they owe money. Or if you screw up as the tax practitioner, right, you like fail to do this, you did that wrong, you were fraudulent, they can get you. Now, with penalties from the IRS, there's essentially two types. There's civil versus criminal. The burden of proof here that's going on is in a civil case, it's a preponderance of the evidence. And what that means is if it was more likely than not, anything more than 50%, you committed the wrong or you did the wrong, you're liable, right? So the idea with that is, hey, you're liable, you're now going to owe a civil penalty. In distinction, a criminal penalty is a higher standard, namely beyond a reasonable doubt. So it's kind of like a 50% standard for a civil penalty. Criminal penalty, reasonable doubt, I don't want to quantify it, but it might be like 80%, 90%. In other words, if you have a doubt at the end that the individual did not commit the wrong and that doubt is reasonable, then they're not going to be guilty. So it's like you're liable in civil law, you're guilty in criminal law, preponderance of the evidence in civil law, beyond a reasonable doubt in criminal law. Now, with regard to penalties, right? So let's just say you're audited. The idea here is they could hit you with penalties and interest. So it's you owe this, right? You owe $500. By the way, we're going to get you a penalty on what you owe of $50, and you owe interest on that of $10. So it's like usually like something. If you owe money or you screw up, they're going to like kind of add on to that 10 different ways for how you owe. So the idea with this is, how do you avoid the penalties? What can we do, right? Well, the idea here is you basically have to have a reasonable basis for when you take tax positions. And the IRS says this, right? If there is substantial authority, namely when you took the position, it was, there was a 35 to 40% chance that it would be sustained, then there will not be a penalty. For example, an underpayment penalty. So yes, you may still owe $500 or whatever it is just from the tax return being screwed up. But if there was like at least a reasonable basis for that position you took for it being screwed up, that is to say there was substantial authority, we're not going to hit you with the additional penalty on top of that. Now, from a tax return preparer, right? So this is someone who kind of prepares returns for compensation. They have a variety of different penalties they can get you with. So you can look at these, right? Like things you screw up. Do not memorize these lists and like specific penalty amounts. Just read through them. Essentially, these are things you should not do as a tax preparer with it. So look through that. And that's going to be the end of this lecture here for Chapter 2.